All right, today we're going to dive into an investment philosophy that's, well, deeply contrarian. It's all about deliberately walking away from what everyone else is doing. We're going to explore the so-called anti ESG portfolio. Now, you've probably heard of ESG, that's environmental, social, and governance. It's a framework investors use to screen for good companies. But the anti ESG approach flips that on its head and asks a really provocative question. Is there actually market beating alpha, real profit, to be found by investing in the very companies ESG screens out? We're talking about the so called sin stocks: tobacco, defense, and oil.
So here's how we're going to break it all down. First, we'll look at why following the crowd in investing can be, well, a terrible idea. Then, we're going to pull back the curtain on the secrets of some legendary contrarian investors. After that, we'll see exactly where they go fishing for hidden value, and we'll apply their playbook directly to these controversial sectors. And finally, and this is super important, we'll get real about the risks versus the potential rewards. All right, let's kick things off by looking at conventional wisdom. Most of us are naturally drawn to what's popular, what's successful, what's growing like a weed. But here's the thing about investing. Sometimes the crowd can lead you straight off a cliff.
To get our heads in the right space, let me ask you something. If you had to pick the absolute worst industries to put your money in right now, just based on how they've been doing lately, what would you pick? I mean, think about the sectors that have been totally beaten down, the ones nobody on TV is hyping up.
Well, if you guessed industries like energy, metals and mining, or oil and gas, you'd be spot on. According to research from Fidelity, these have been some of the absolute dogs of the market recently. They're unpopular, they're unloved, and for a lot of investors, they're completely untouchable. But that, my friends, is exactly where our story gets interesting. You see, a legendary investor like Peter Lynch, the guy who ran one of the most successful funds in history, he would look at that list of losers and his eyes would light up. He famously argued that the secret to finding those life-changing investments, what he called 10 baggers, was to look for great companies in totally lousy industries. And that right there is the core of the contrarian mindset. So why on earth would he do that? This slide really lays it all out. Think about it. A hot industry, one with incredible growth. It attracts a ton of competition. Pretty soon, everyone and their cousin wants to start a business in that space. And all that competition just eats away at the profits. But in a lousy industry, competition is weak. Heck, as it says here, companies are dying like flies. If you can find the one strong survivor in that kind of brutal environment, it can end up dominating its market as everyone else goes bust, capturing all that market share and becoming wildly profitable. And this brings us right to the heart of the contrarian philosophy. It's not just about buying cheap stuff. It's about having a completely different point of view than the rest of the market. And to really get this, let's hear from a few of the absolute masters of this game. Howard Marks just nails it here. It's simple, right? You cannot get above average results by thinking like everybody else. You have to see value where other people only see garbage. But, and this is the critical part, you also have to be right. Just being different for the sake of being different, that's a great way to lose money. Your contrarian view has to be backed up by solid facts and real analysis. And then you've got the billionaire activist investor Carl Icahn, who takes that idea and puts it on steroids. He's not just okay with unglamorous, out-of-favor companies. He actively hunts for them. He knows that when an entire industry is hated, the market just panics and throws out the good companies along with the bad. And that creates these incredible bargains for anyone willing to actually do the homework.
And of course, we have to talk about Warren Buffett, who gives us maybe the best analogy for all of this. He tells us to picture the stock market as a business partner named Mr. Market, who happens to be manic depressive. Some days, he's totally euphoric, offering to buy your shares at crazy high prices. On other days, he's terrified and offers to sell you his shares for pennies on the dollar. The point is, you don't follow his wild mood swings. You ignore his euphoria and you absolutely take advantage of his pessimism. His fear is your opportunity. Okay, so we're getting the mindset. But where do you actually go to find these deals? If you're going to swim against the current, you need to know which ponds to fish in.
Well, this slide gives us some of the classic hunting grounds. You've got industries that look totally obsolete, right? Like companies that move physical cash around in a world that's going digital. You've got good companies that just hit a temporary rough patch and got a bad rap. And then you have the big one for our purposes today, the controversial, inappropriate stuff. Oil, war, gambling. Basically, you're looking anywhere the market is pessimistic and has probably overlooked something really valuable. So one of the big strategies they use is something called an asset play. This is a classic idea from Benjamin Graham, Buffett's mentor. It's where the company's stock price, its market value, is actually less than the value of all its stuff, its cash, its real estate, its patents. The market might be freaking out about bad earnings this quarter, but it's completely missed the fact that the company is sitting on a mountain of valuable assets. And that leads us to another one of my favorite concepts from a young Warren Buffett, the cigar butt investment. The analogy is just brilliant. Imagine you're walking down the street and you find a discarded cigar butt that has one good puff left in it. It costs you nothing to pick it up, and you get that one last puff for free. It's the same idea with a business. You find a struggling company that's trading for such a dirt cheap price that you can probably squeeze one last bit of profit out of it. It's not pretty, but hey, it can be very effective. All right, so let's tie all this theory together. How do these contrarian ideas, these asset plays and cigar butts, apply directly to this anti-ESG or sin stock universe? Well, here they are, the big three. These are the sectors that tons of modern investors and big funds actively avoid because of that ESG framework we talked about. You've got energy because of its environmental impact, defense because of its role in war, and so-called vice stocks like tobacco and alcohol for their social costs. And because so many people refuse to own them, these industries can become those perfect, lousy, or unloved pawns, where contrarians start looking for those mispriced gems. This is a perfect example of a sin stock as a cigar butt investment. Just look at the tobacco industry. Everyone knows it's a business in long-term decline, but big players like Altria and Philip Morris have turned into unbelievable cash flow machines. How? Well, the products are addictive, which creates steady demand. And all the lawsuits and regulations over the decades have built this massive wall around the industry. Nobody is starting a new tobacco company today, and that lack of competition gives them huge pricing power. They just gush cash, and they send it right back to shareholders through massive dividends. And check this out. Here's another great example, but this time of an asset play. The source material points to an investment that, on the surface, looks like your typical oil and gas company, an industry a lot of people won't touch because of climate change. But if you actually pop the hood and look at the balance sheet, it's a classic Benjamin Graham play. The company is sitting on so much cash and so many marketable securities that you're essentially buying a dollar's worth of cash for, say, 50 cents, and you're getting the entire oil business for free. Okay, this all sounds pretty compelling in theory, but let's be crystal clear. Buying what everyone else hates is not a risk-free strategy, not even close. We have to be brutally honest about the dangers here. And the risks are very, very real. You've got huge political and geopolitical risks. A war in the Middle East can send oil prices haywire. There's obsolescence risk. I mean, what happens if someone invents a portable fusion reactor? Then you have the dreaded value trap. That's a stock that looks cheap, but it just keeps getting cheaper and cheaper and cheaper because the business is fundamentally broken. And finally, there's the simplest risk of all. Your brilliant non-consensus view might just be plain wrong. But here's the other side of that coin. There's a reason big institutional money often flows into some of these sectors when the economy starts looking shaky. This chart shows what are often called defensive sectors. When investors get scared about a recession or a bear market, they tend to sell their high-flying tech stocks and pile into things like consumer staples, energy, and healthcare. Why? It's simple. People still need to eat, they still need to heat their homes, and they still need to go to the doctor no matter what the economy is doing. And at the end of the day, this quote from the great Charlie Munger just captures the whole philosophy perfectly. Investing in these unloved areas isn't about being some kind of genius who can predict the future. It's really about risk management. It's about buying assets so cheap that you have a margin of safety baked right in. It's about consistently trying not to do stupid things and letting the market's pessimism create your opportunities for you. And that brings us to our final question, the idea at the very heart of this whole explainer. The market, by its very nature, punishes companies and industries that are unpopular or controversial or out of favor. So, as an investor, you have a choice. Is your job to stand there with the crowd and agree with that punishment? Or is your job to look past the noise, analyze the facts, and potentially profit from the market's emotional overreaction? The answer to that question really defines what kind of investor you want to be.